What's interesting about senior living is it has a demand and a supply problem. From a demand perspective, the 80 plus cohort, that cohort is growing at 28% over the next 4 years. That is insane. That's going to go from like 63 million people, which is today, to about 75 million people in the next 4 years. Our investment gap is like $258 billion. And we would have to increase the development pace today 3.5 times to meet the need that's coming. You've got this massive amount of demand coming in, and we're seeing many markets where occupancy is like 98%, 99%, many with wait lists.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Radhika Rastogi, welcome to the show. I am happy to have you here to talk about senior living, not just senior living, the residential, smaller ones that you others are listening might have heard about, but much bigger communities as we're going to get into today. And what I love about having this conversation with you is that you really know the listeners to this podcast, being in healthcare and tech, and having been in that industry for a while, and also having some children of your own, which I know is part of the impact of your story, and really just kind of understanding needs of who these busy professionals are that do need to invest and are time constrained, right? Pleased to have you here. Would you please introduce yourself with your words and talk a little about who you are, what you do, and then we'll get into it.
Absolutely. Stephen, thank you so much for having me. I'm really excited to have this conversation with you. A bit about my background. So on paper, I think my background looks very traditional. I've spent over a decade in healthcare consulting, where I've worked primarily in highly regulated environments with government entities, insurance providers, healthcare providers, managing complex portfolios. So that gave me what I call a front row seat into how policy, incentives, and capital decisions really affect people and the outcomes. Alongside that, as a W 2 employee, I've been investing in real estate for, again, over a decade. And today I'm the co founder and managing partner at Relik Capital Group, where we specialize solely in senior living. I'm also a wife and a mom of two young boys, so that's significantly shifted how I think about risk and time. And yeah, I'm excited to be here and share more about my background and what do we look for in deals and that sort of thing.
Cool. So you talked about investing in real estate for the last 10 years now, pretty much 10 years. And if I had done the research correctly, you were doing single family rentals before you got into the space of senior living, right?
That's exactly right. I think I started like most people do, starting with residential, with buying our own home primary, and then deciding to buy a larger home and putting that one out for rent and doing that over and over again. So what I quickly realized was how unscalable that model is. And I was buying properties in California. So, like, putting the down payment, none of it was easy. The returns, frankly, made no sense for the amount of cash I had to infuse into the assets. So, eventually, we decided to stop that strategy and moved completely into commercial.
See, this is a question I always like to kind of get into, especially for the pain of investing in some single family homes when you're starting and just getting to that point of, I need to go bigger and start scaling, or, this is, I can't be using my own capital because I've used a bunch of this. And so what was that aha moment, like that event where that could give you that insight?
I actually have a really good story about this. I remember this so vividly. I was sitting in my garage. This was during the times of COVID. So I had been relegated out of my home into the garage so I could have a little bit of quiet while I was working. And I was doing a calculation of, okay, how many homes would we need to buy and manage in order to replace my W 2 income at that time? And the number came to 120. And I was like, okay, that is never going to happen. Because one, I don't have capital to be buying 120 homes. And two, I don't want to manage 120 homes. So that was the moment that I was like, we have been going towards this strategy Frankly, without having done this math, like I think if I had done this math earlier, I would have been like why bother type thing. Like it just never made sense. But it was a good learning curve. And anyway, we figured it out and moved in a different direction.
Yeah, totally. But it's kind of funny, isn't it? Like you get that far and it takes you to get that far to do that math and you're like, "What was I thinking?"
Yeah. Yeah.
All right. I just had to ask because I think if we can save someone else listening like years of time to do that math now to think, how do we invest with other people? How do we partner with other people? Then it's definitely worth it. We're here talking senior living. So there's a couple things. Tell us a little bit about the asset class and then talk about what the problem is. Like, what does it actually solve? Obviously, like senior living, if you could maybe give a backdrop of just briefly, I know there's types of different care and what you focus on and how that helps to solve the problem too. People listening, they really want to get an idea of what problem does this really solve as an asset class.
Yeah, sure. That's a good question. So, senior living or senior housing is sometimes referred to is essentially communities where elderly go in to live when they typically need additional care. So, the senior living spectrum, I like to call it, is like three phases. The first phase is independent living. This is similar to like the 55 and over communities, or very much like a multifamily where older people live together, but they get a lot of different community amenities that they might not get if they were living in a single family home in a neighborhood. Independent living does not include any healthcare. So there's no like medical aspects to it. There's no like wellness testing. It's really just a multifamily with older people.
Mm-hmm.
The second phase, or as we kind of go down the acuity level, is assisted living. Assisted living is where we as in our operators help with active daily living. These are things like helping get them dressed, helping give them food, going to the bathroom, sometimes taking them to their medical appointments. And then the last phase, or the third part of senior housing, is memory care. This is for individuals who have dementia, Alzheimer's, Parkinson's. So they're actually dealing with their memory and not remembering things. So what we typically see is families at some point or another hit a wall. It becomes really difficult to start taking care of patients or residents who have Alzheimer's or dementia. So they need a lot more hands on care. They need to be in a secure community where they're not just walking out. So it's a blend of assisted living, and on top of that, we provide uh, very specialized staff to help with the types of ailments that they might have.
Got it. Appreciate that. So the first one was sort of independent. The second one was assisted, and the third one is the memory care. And
Yeah,
for any of us listening to the opportunities from what's happening, there's things like silver tsunami, baby boomers, and aging populations, right? And so it's probably going to see more and more of this as well. Is that kind of a line in trend what you're seeing as
100%.
well?
100%. Yeah, I think. And so, like, why I loved this asset class was, and again, I was leaving residential real estate. So I was like, okay, I need something that's more secure. I'm not trying to get into something that's just a ton of high growth, but significant risk. That was what I was personally looking for. What's interesting about senior living is it has a demand and a supply problem. So,
Mm,
from a demand perspective, the 80 plus cohort, and this is really the primary segment when it comes to senior living, especially like assisted and memory care, that cohort is growing at 28% over the next 4 years. That is insane. That's going to go from 63 million people, which is today, to about 75 million people in the next 4 years.
yeah.
And what I find fascinating, and this is something new I actually just recently read about, was today, like over 40% of the seniors can actually afford senior housing without liquidating their assets. Because a lot of the stories behind like what you see in the media is
Hmm.
absurd charges and a lot of seniors struggling to pay, which is definitely true in some markets. But what we're seeing is the private pay market where they're not diluting their home, they're not pulling from a lot of different social security or funding sources, they just have capital built in. It means that the private pay demand pool is actually deeper than many people assume. And that's a good news for
Yeah.
investors. And on the supply side, if I just give like maybe one piece of data here, is supply is incredibly low. Like it's literally not changing. So I was reading a report a couple months ago that said our investment gap is like $258 billion. And we would have to increase the development pace today 3.5 times to meet the need that's coming. And as you probably know, the government is not incentivizing builders to go out and build, right? The cost of materials is high. Immigration policies are causing other issues. So no one's building, but you've got this massive amount of demand coming in. And we're seeing many markets where occupancy is like 98%, 99%, many with wait lists. It's a
Yep.
perfect problem for an investor.
So you said no one's building. Do you think that will change? But even if they do change, what you're still talking about is these communities are waitlisted because, like you said, the quote unquote supply are elderly that do need care because this is all of
Yeah.
our parents and grandparents and their people, right, are going to need
Right.
this care. Do you see that there's a trend to starting to be people be building
I
anywhere?
think people are trying to figure out how to build because I think everybody recognizes like the need is there. The challenge is, and if I like give you an example, so when I looked at what if we did a ground up development, what would that cost?
Yep.
Average cost is about 350,000 per unit, right?
Wow.
Acquisition, like the deals that I acquire right now, and again, these are underperforming with the goal of stabilizing them. So we can buy an asset for less than 100,000 per unit. So if you
Cool.
just look at that, plus the time it takes to build and the time it takes to lease up that building, you might be looking at a minimum of 5 years before it's actually ready for full usage.
Hmm. Yeah.
You have to really think about the ROI on that, right? Then how long is your break even point?
And so ultimately what that numbers you were just talking about is a ground up would be 300K and the acquisition would be 100K. So 3x to build for it to even be ready. And before we go on to more about your quote unquote buy box and what deals you're looking for, I'm curious if you can expand on, are there any additional data points or things you can talk about on your research? You said that more care can be paid for without seniors having to liquidate their assets. I think that part is particularly interesting too. What do you end up finding there? People can
Yeah.
just pay out of
So
pocket or something?
yeah, out of pocket. So typically, we see a few different ways that seniors tend to fund senior care. One is long term care insurance, the second is Medicare. So, Medicare does not cover services, but it will cover portion. And in many states, the reimbursement rate fluctuates. But if I give you an example, like in Texas, the average reimbursement rate is 2,300 bucks. But that's like
Mhm.
significantly below most markets. So what tends to happen is the operator or the community would say, okay, pay the 2,300 that's coming from Medicare, but then supplement another $2,000 from your personal disposable funds. And then a lot of the boomers do have access to Social Security, so that's the third primary source. In other markets, the final primary source is people liquidating their assets, selling their homes, or pulling a HELOC and then
Mhm.
paying for senior care that way. So I look at it in two ways. Like when I talk to investors, it's have you one considered this for your family or for your parents? Because this is a conversation I ended up having with my parents of wow, I didn't realize like we should be having this conversation. But two, from like an investment standpoint, it's there are ways to pay for it. You just have to be prepared, but you have to think about this early because you can't just get long-term care insurance a year
Right.
before you need it. Your premiums are gonna be crazy.
Got it. Got it. I know this isn't the focus of it. Many of us have aging parents. I do too. I mean, everybody's aging, but kind of that thing to think about. Like you said, I didn't know this was a conversation I had to be having.
Yeah.
It's sort of the realities which makes this quote unquote asset so tangible and kind of close to home too, even though it is, well, business too, investment perspective. So talk a little about the asset class now, pivoting to, you said this is something you guys acquire and you do turnarounds. Let's dive into that. Talk a little bit about that model and then maybe a case where you brought in an operator for this turnaround. Give me an example. Let's
Yeah,
walk through
sure.
that model.
Yeah, sure. So what we typically do is we follow a syndication strategy. So syndication for your listeners is when multiple investors pool their capital together to purchase one specific asset. So we work a lot with retail investors who might invest anywhere between 75K to 100K per deal. and we pool that money, acquire an underperforming asset. So, a couple things that we always look for are 70% to 80% occupancy. We want it to be low, but not like distressed, right? We don't want
Mhm.
it to be zero or vacant. We like to see really high expense ratios. So, usually like 80%, 100% expense ratios. Basically, you're losing money on the deal or from an operations standpoint. And that to me means there's clearly space to optimize expenses, space to cut certain things, or just change how we do our revenue structuring. A couple other things that we look for are there's several different revenue streams in senior care. It's not just room rentals like multifamily. So, a really big revenue stream is called level of care fees. These are supplemental fees that every resident pays if literal like hands-on time with staff members is beyond a certain amount. So I'll give you an example. If you have a resident who just needs help with remembering to take medications and assistance walking down a hallway, they might pay a supplemental payment of 200 bucks extra per month on top of their room rate. On the other hand, if you have a resident that needs help with bathing, grooming, going to the bathroom, like going to appointments, and then helping the family plan for hospice care and coordination, that all of that might be $1,300 additional on top of the room rate. So, what we typically see are many people have either decided not to charge this level of care fee, which we see a lot of off market or older sellers who've had their properties for a very long time just miss this really big revenue stream. So, those are the kinds of things that we look for. An example of one deal, this is a closed deal that we've already finished acquiring, but we found an asset. It was 50 units, assisted living only in New Braunfels, Texas. And we purchased it for 4.6 million, it's about $92,000 per unit. And what we loved about this deal was it was run by the owner that ended up building the building. So they've had it for many years. They took great care of it. The physical asset itself was in pretty good shape, but the seller was like 70 years old. He's, I want to retire. I just want to like chill. And
Yep.
the opportunity here was $600 below market were the rents. They were not charging level of care fee. They were not even doing marketing. So there was no digital marketing. If I
Yep.
showed you a brochure, it'd be completely blurry. The website was archaic, very much a mom and pop operation. And our business plan was very simple. It was acquire, transition, put in all the different systems that our operator has, technology as well as processes, and just begin marketing and just raise rents, right? Like the simple the business plan, the better. I think there's a rate of execution. So
Oh yeah.
we closed that deal last quarter.
Awesome. Congratulations. Yeah, New Braunfels is just about 40, 45 minutes south of me. I'll be looking for, oh, Radhika's and
Yeah.
team. How do you, so kind of interesting. How did you find that deal?
It was off market. Our operator actually brought it to us.
Okay. Yellow letters and direct mail. It's interesting, right? So it sounds like many of these places, if it's been that one owner for a period of time, these aren't newer facilities. And I say newer, A class, B class, C class type of thing. Is that,
They're
I mean,
typically B class. So
okay,
yes, they were built like this one was built in 1996, and then renovated in 2004. But even yeah, it's like still 20 years old. That is what you're going to see. It's either going to be a lot of 20 to 30-year-old buildings, which is considered class B in this case,
got it.
or you find like everything that was built past 2010 or new developments being class A.
Got it. 20-ish years is still kind of class A then. Yeah, that's interesting. That's why I was asking. I'm like, how does that work here? I remember seeing buildings like this in Seattle where I was living before.
Yeah.
And I think it was a conversion from like a senior care or something to a multifamily. And that place must have been from like the 50s. And I was like, huh. Okay. You talk to me like, how did you connect with the operator? So, operator in this case, the equivalent is kind of like what? Property management group, so to speak, right?
Yeah, the equivalent would be a property management company. So finding a good operator is the hardest challenge. So to
Hmm.
find this one operator, we interviewed like 75 different companies. And something
Hmm.
that we realized, and like our model ended up kind of shifting a little bit, because initially we started going, well, let's go with the bigger national operators. They've been doing this forever. They have all the systems in place. They can scale easily, but they also have a ton of overhead. So when
Absolutely.
we talk about like delivering certain types of returns to our investors, they just could never hit our minimums, and they were incredibly bloated. We would have to pay for every little thing. Marketing was a completely different fee. Accounting was
Hmm.
a completely different fee. Nothing was really built in-house. Like they seemed vertically integrated, but it really wasn't. It was everybody just parsing things out, everybody adding their own
Got it.
margin. We ended up ditching that idea, decided to go full on just regional operators. So these are smaller
Nice.
companies. They still have systems, they still have processes,
Hmm.
but their expenses are not so bloated so that they can actually help us reach the returns we want to reach. But that review process, so just to give you kind of further that, so we interviewed 75 and we selected 3 that we were willing to work with. A
Shortlisted
lot
them.
of it,
Right.
yeah, a lot of it came down to one, can you underwrite? Is your underwriting methodology similar to ours? Do you really understand numbers? So many couldn't even explain the numbers, which was just like, you're the one running the day
Yeah.
to day. You can't explain the
Yeah.
numbers. It's a big problem. And then a lot of it was like values, and do we have the same goals? Do we see the same thing when we look at communities in terms of what does good resident care look like?
Yep.
And of course, we still want to think about the investor. So they have to understand like we represent an investor group. So returns are important. And we are going to be talking about how to cut expenses, but like in a way that is meaningful, but not disruptive to the families and to the resident.
Yeah, totally. Makes sense. Are each of these a syndication? Are you are yeah, okay, each one is a syndication. And you talked about stabilizing and grave, and that example we talked about could be for 5 years as an example. Is that about the normal time for stabilizing this type of asset class or
It depends on the deal. Most of our deals and what we look for. So one of the differentiators, I guess, that we have compared to other syndicators out there are we only purchase deals where one, the business plan is simple enough to turn around quickly. The second is we want to do a cash out refi by the end of year 3. And the goal of that refi is to return 100% of the investor's capital. 2 reasons why we
got it?
do this. One is we want to de-risk LPs as soon as possible in the deal. We don't want to wait until sale to give them their initial principal back. Right? Ideally, they reinvested with us in a different deal or they do it something else that they want with it, right? But anything else we give them after returning that capital is a cherry on top.
Mhm.
That's our number one principle of capital preservation. The second reason we do this is because I co invest personally in all of my deals. And I also want my money out as soon as possible so I can go reinvest it, right? So it's
Right.
an aligned incentive. So most of our turnarounds are between 12 to 18 months.
To which point? You talked about the refi around 3 years. So
To
what
stabilize the asset.
to stabilize. Okay. To stabilize is 12 to 18 months. Okay. So that, like you were talking about earlier, your buy box is somewhere around the 80%. So that means you should be able to go to what, 80 to what is considered stabilized for this asset class, 90, 95?
90 to 92. I don't like to go above 92, even if the market is showing proof of it. I
Mhm.
usually don't underwrite beyond that.
Okay. Cool. Makes sense. Just as a kind of a footnote, kind of a interesting thing too, right? Because that means there will be some wait list still likely. And
Yeah.
at the end of the day, like everything, it serves the community, but you also have to make sure numbers pencil.
100%. And one thing to call out there is acuity is really important. So I talked about the level of cares, but we also have to make sure that we, just because the level of care for like level 4 is $1,300, we cannot fill that community with everybody that's a level 4,
Totally.
right? Because our staffing would be screwed. Like our
Yeah.
expenses for staffing would be so high that we would actually lose money on the whole deal. So it's a bit of an art of
Mhm.
making sure we're keeping that bell curve, that we do have some residents that are lower acuity, that are they just pay the room rate and we're good enough there. And really that's, I think that actually is a that's in service to the people who need the help, to make sure that the staff is available and physically and emotionally not burdened so that they can actually support.
Yeah, I was going to say that's actually that it's a wise business decision focused on the people to have that capacity to continue to help them.
Yeah.
Yeah, good call. So, based on that, what's the velocity of deal? Are you how often are you looking or would like to do acquisitions?
Oh my God, we would love to do 6 to 8 acquisitions a year, but
Mhm.
we're very selective. So we have created an internal risk management framework. It's called, we like to call it P execute. It's the probability of successful execution. And it looks at like 300 different data points to say, is this deal going to successfully pass being executed, right? The
Sure.
higher that number, the more chance of us delivering the returns to our investors. Because of that framework, we typically own. So, if I give you an example, we underwrite 30 deals a month, review them, we would LOI 10 of them. And of those 10, we would go to PSA with 0.1%. So, the chances of us actually going through with a deal are very low. And that's by design, right? That's
Yep.
to make sure that we're protecting LPs, that the deal is actually a good deal before we move forward.
Spoken like a wonderful consultant mind, Radhika. Thank you.
At least
Yeah.
that's what my background taught me, whereas build a framework, make sure it makes sense, it's repeatable.
Yeah, I was gonna ask, right? I always think, and this is things I've learned from acquisition labs and my training over time, is when you're looking at the businesses, when you're looking at whatever you're getting involved in, it's always you plus business equals a success. Meaning, what skills do you bring there so that it can be how do you plug in to make it successful? Obviously, you talked about being in that space, about healthcare, being a tech consultant. I've heard you talk about underwriting as one of your superpowers. No
Yeah.
doubt you're making sure that's a high priority. And what did you say, a 300-point framework or
Mhm.
so for your P
Yeah.
execute? Love that. Got to have functions. No doubt spreadsheets. And so I've got to ask, how are you, just kind of high level, two parts. One, how are you bringing tech and AI into your underwriting side? And what are you thinking about or what have you decided? Because I'm sure you've thought about it. What have you decided with your operator and things that you're doing to stabilize, but also improve the care for these communities too with tech?
Yeah, that's a good question. Let me answer on our business side first. So, our P execute framework is built on an AI infrastructure. So, we have captured data. And actually, that framework came from us doing a really bad deal. This was before we had investors. This was my money that I put up and tried to figure out, like, do I want to do this or not do this?
Yep.
And that deal just sucked. We made every did mistake that we could, and I'm so glad we did because it was the reason of how we self-corrected. Thankfully, that deal came back on track and things are okay, but it taught me everything I needed to know on protecting capital and protecting LPs. So, it came out of necessity, but
Mhm.
because of that, we've become very methodical about the different categories and like specific metrics within each category. So all of that is built on AI. And so what I literally do is I throw in an OM and I have it
Mhm.
run through and naturally like it shoots out a report that's based off of our proprietary information. And then I review it and say, okay, how much of this is truly accurate and how much is not. That's a good example of how we're using AI to speed up. And frankly, this is the only way we get to underwrite and review 30
That
deals a
many.
month. We are beginning to build an underwriting agent. So senior living underwriting is 50 times more complicated than multifamily underwriting because you really can't just summarize and annualize everything. You have to think about it from a month to month basis and like lease up goes up and like your staffing goes up on a monthly basis. So it's much more granular. So we are starting to train our agent. So the goal is it even if it could just do a napkin underwriting
Right.
quickly for me and then I would just do the full underwriting myself, that's an option. From a care standpoint, we have implemented in one of our communities like a voice agent. It did not work
Mm.
well. What we have found is
Mhm.
families don't like talking to them, seniors don't like talking to them. We ended up removing it, but a lot of the AI is coming in back office, right? So accounting,
Yeah.
financials, marketing, sales, the entire business aspect is supported by AI. A lot of that's because we use a lot of different SaaS tools. They are inherently upgrading their platform, so that helps us. But the
Hmm.
care piece, and this is what we want the care team to not be burdened by back office stuff and
Yep.
administrative stuff, so they have more time to actually deliver care. So care hasn't really changed meaningfully, I would say, with AI, and I think that's the intent.
Yeah. Yeah. Of course. That means more time focused on the customer, less time on the business stuff, or
Yeah.
less time on the administrative, so to speak. Super cool. I think it's interesting too. I've heard you talk about how in this space, this is real estate, hospitality plus healthcare, right?
Yeah.
Hospitality part. And you see a similar idea with RV parks and to a degree, like mobile home parks as well. Obviously, it's not the same level of care, but you have a different level of trained staff because if future people, they probably have some people are more skilled than others, which a certification or doctors or whatever, varying level of skilled staff that are in that community. Plus, just plugging in. Sorry, I mean, come on, we're got to nerd out in some of the data aspects, but you have different bodies of data to plug into and to get more accuracy on that as well, et cetera, et cetera. So
Yeah, exactly.
this is for tech professionals.
Yeah, they
They're
get it.
track.
Yeah.
They're track. Very cool. Yeah, the going through a lot and finding ways to stay in touch with communities too, because just like anything, it may not be that they're ready to sell today. The numbers may not work out based on purchase price, but it
Mhm.
could be that later on they end up do want to come back and sell with you too.
Yeah, hopefully.
Yep,
To buy.
I got you. Cool. I kind of want to do a full circle here. We opened and talked about this from you really looking at getting to senior living at this asset class from doing the math of how many single families do I need and it being 100 plus. There are people that have maybe have bought their own home and or have considered one rental. And I've had people come to me, hey, Arita, what should I do to get started with investing? My last name.
Yeah.
And some people have heard about the flip thing, right? And I'm like, yes, you can if you have the time and you want to get a couple bruises at the first time around. But what do you wish that you knew when you first started investing, coming from the W 2 and thinking about, I've got my income, but it'd be really nice to create more income streams. So, being where you are now, what advice would you give for those people looking to invest?
I think if I could go back and tell myself, like, I was very much close-minded. I assumed I had to know everything to do everything. And I think that's why I went into residential. I was like, oh, I've bought a house before. This is the same thing. We just do it over and over again. And it was kind of I don't know, it was just really strange to get my mindset to, oh, I can actually depend on sponsors that have an expertise in this particular area, which one I don't want to know. Like, I don't want to build 30 years of experience in senior living, but I can tap in with frankly nominal dollars, right? Like when I compare to a down payment buying a home in California, for example, I can invest with 50K, see how I feel about it. See, one, do I like syndications at all? Two, do I
Mhm.
like this asset class at all? Do I like this particular sponsor? And like, I always tell investors, because sometimes like they're so scared to just lose the 50K. I always
Mhm.
tell them, okay, what are you losing by not investing? What is the opportunity cost to not invest? And at least in our deals, every 5 years, assuming everything goes to plan, or even if it goes like towards our sensitivity analysis, we're a minimum doubling your money every 5 years. So if you go from 50 to 100 by the time you exit and you're getting the 50K back by year 3 and you're redeploying it, the key thing is how do you keep your money working for you? So you just keep using that same 50K deployed across multiple vehicles over a period of a decade. Now
Mhm.
you can actually end a decade later with over $1 million. And your time has been what you've saved. Because now you've found a sponsor you like, you've trusted them, they've delivered, ideally, and you're just repeating. It's easier.
Yeah. So, what you've learned is working, trusting others and working with them, like
Yeah.
partnering.
Partnering, exactly. So, first, trusting them, make sure they're the right fit, right? Not just in terms of numbers, but in terms of values, in terms of ethics, right? So, those things are vital, but then try one deal, just see how it goes. Like, I think I was so afraid to try earlier on, but then I would spend $200,000 buying a home, right?
Mhm.
Versus 50K buying a proportional interest in a deal. And I would still make more money with a syndication at 50K than I did with a residential home that was making maybe 150 bucks a month.
Do you remember what was if there was a thing or two that made you think, kind of get over that working with other people and partnering with them?
Yeah, I actually built a calculator for myself on what would I lose if I lost that 50K, what would that really do to me?
Mhm.
And if I didn't lose it, but if I got proportional to whatever the sponsor was saying,
Mhm.
what would I do with that money? And for me, like that gap was it was not so much about the 50K losing, it was more of I'm leaving six figures on the table and I don't even really know why other than I'm scared.
Sure. Yeah.
I had to quantify it as a consultant would.
Yeah, yeah, I get it. I get it. I did the same thing with I invested in one and it didn't go as great as we hoped it would. Similarly, but it's going fine and it's the same kind of thing. And so you got to look at the
Yeah,
numbers. Otherwise, it's this abstract fear.
100%. I mean, I'm not like we've done a fix and flip and made every mistake possible too. So it's do I want to go through that again where I invest a shit ton of money and make all these decisions myself? And yes, I would feel like I'm in control, but do I have the time to do that
Yeah.
again? And or the risk appetite? And I just don't. Like I don't anymore.
Yeah, I get it. The time thing is definitely there. You plan to stay in California?
My wife. I mean, I love it.
um,
Home is here, but you know, on a daily basis, maybe I'll come to Texas. My brother lives there.
cool. Your assets are across the Sun Belt, right? Is what we're looking for. Very cool. Is there anything else that you would tell other higher income tech professionals, consultants, whatever, who are looking at making investments? Who are looking at making investments? Anything else
Yeah,
come to
I
mind?
think about depreciation if you're not already. Think about
Mhm.
how to keep more in your pocket. And then something else that like really worked for me was I just needed to be surrounded by people who were in a similar mindset. Like I had to change my circle. And a big part of that was me joining a mastermind. And again, at the time I was going full on passive. I had no intention of being an active general partner. But I
Mhm.
joined a mastermind, and the goal was to have access to a bunch of sponsors. And the point was, how am I going to vet so many people in one? I need to know what's different about all of them, but it gave me one channel where I could talk to people, learn different things, and really kind of figure out who's the cream of the crop. And
Yeah.
I think that was a good investment that I made to make it easy for me to find, okay, here's a group of people I can vet before I move forward.
I completely agree. It sucks to feel like you're all on your own. And for the people just working in their environment, people are so concerned with the next tech that comes out or just
Yeah.
whatever, right? It's getting involved in with the group of people that are investor focused,
Yeah.
and thinking about just different mindsets, even growing as an entrepreneur, right?
Oh my
Is a
gosh.
huge one.
That's a big
Um,
one that I've lately been, like, trying to figure out more is, like, okay, how do you scale? And, like, ideally, we wanna be, like, $100,000,000 company. So how do you scale to that, and what are the processes you need to have in place today or as you're scaling? So, yeah.
Yeah, and I think even investing in passively in a deal or two will make you better while you're still there
Yeah.
in your W-2 as well, because you become that much more of an owner too.
Yeah.
Yeah. Anything else you wanna share? This was a lot of fun.
No, I think I'm excited again, if you wanna reach out to me, I love taking calls with people who are thinking about senior living. I think my LinkedIn is gonna be available in the show notes. I'm also very active, and most of my LinkedIn content is educational. Perfect place to get some just value, hopefully.
Yeah, absolutely. We'll make sure it's in the show notes, and you have your own podcast as well. It's the Rich Roots podcast, is that right?
Right, yeah.
Yeah. So Rich Roots podcast, we'll get that in the show notes too. Check out her stuff. We'll learn more about senior living communities, investing. And Radhika, thank you so much for being here.
Absolutely. Thanks, Steven. Appreciate it.
Appreciate it. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.